Welcome to episode 3 of the fundraising series at VakilSearch. My name is Antim Amlan and I'm here today to speak about equity versus debt financing for startups. So let's understand what is equity and debt financing. In this case, both the types of financing are to help a startup raise money and grow the business. In equity-based financing, the financing is done by the help of investors who come in as the investors and shareholders for that business. But in case of a debt financing, the investors are usually lending money to the business without taking any ownership or controlling stakes. So come, let's do a quick check on what is equity financing versus debt financing. Let's do a comparison test first. A debt financing is a liability for the company in the accounting books, whereas an equity financing is basically an asset for the company. Any financier based on debt will be a lender to the company, right? And the company is financially obligated for the loans. Whereas in case of equity financing, the financier or the investor, let's say, will be on the capitalization table of the company, or known as cap tables. And this investor or shareholder will be becoming a part of the company, sometimes becoming a shareholder, or at moments a board observer or member as well. A loan is usually based on a short-term financing and based on a fixed interest rate, whereas an equity financing is usually for the shares and stakes of the company and is for a longer term as compared to loan or debt financing. So debt financing is usually of two types, secured and unsecured. A secured loan or secured debt is considered when it is backed by any underlying asset as a collateral, something like mortgage based on a particular collateral. Some other forms of secured loans can also be done in case of a company or a startup when you are pledging your shares. Whereas if we compare a secured loan to an unsecured loans are not backed by any kind of underlying asset or any kind of security, which means that there is no particular asset that the lender can occupy if the borrower does not pay. So how does it work then? You can definitely understand loans which are secured and unsecured if you go and meet any of the lenders or any of the banks or NBFCs which focus on giving debt financing. Some common instruments used for secured loans are known as mortgage or pledging of shares, secured debentures, whereas some common forms of unsecured debts in case of a company or a startup is at times intercorporate deposit or a loan from the directors. Now coming to equity financing. Equity financing is a whole different animal. I'm sure you must have heard about your favorite startups, where you order your food or your fashion or your apparel becoming a big startup by raising more money. You have, right? So this is usually happens using equity financing as a model. Let's understand what is equity financing and why do we hear about these skyrocketing valuations every day from our favorite startups. So equity financing is usually when a particular fund, let's say, are called as venture capital funds or angel investors or any high net worth individual putting in their money into a startup and helping them with their growth. As we have discussed in your previous episodes, you can always rewatch to learn what and how these funding works and why do these investors invest. We'll be exploring in the upcoming episodes. Now in equity financing, there are two major types of investors, let's say, in India. One of them are called angel investors and a bunch of them are called venture capital funds. So angel investors are the ones who come in for early stage investments or early stage capital, basically working with very small and young startups in helping them grow. Angel investors usually put their money and are basically individuals with a lot of money and idea and experience to help their startups in the field where they have already done and achieved something. Whereas venture capital funds are nothing but a structured business and a partnership which works with a series of or a group of high net worth individuals in pooling their money, putting it as a fund and managing that fund in investing into startups with a particular focus and approach. Angel investors usually prefer passive investment, means they have lesser involvement because they come in and they believe in the founders, they put their money at a very early stage, then they wait to see what happens if any bigger venture fund comes and then buys their equity or increases the value of their equity in the startup. Whereas a venture capital fund are more focused, they prefer more controlling terms, and if they're investing, they'll always ask for a preferring and controlling terms where they can exert some of their decision making into the board of the startups. Also, one very important point to add is that in this equity financing space, all these angel investors and the venture capital funds, they prefer having a safe exit route, or let's say a exit right. Exit rights is where they plan and they manage their risks or hedge their risk that they're putting or taking by putting in investments into a startup or by coming in as the shareholders of a particular startup. Preferring an exit right or ensuring a good exit right always helps the investors in taking an exit from the company in case the company is not doing well or functioning as per the terms agreed in the signed term sheet or shareholders agreement. To tell you more about it, we will be doing further episodes on term sheets and shareholders agreement where we'll be explaining how do you manage these terms, how do you negotiate these terms. Now coming back to some common instruments for equity financing. Equity financing are usually done through share instruments. When we call share instruments, there are various types of shares that we'll be understanding in the upcoming episodes, such as equity shares, preference shares, some form of debentures, and all of these shares have a type of conversion or convertibility, especially the preference shares and debentures. And there is a way to structure the transactions when you are investing to a particular startup. That's all for today. See you in the next episode. To know more about fundraising and the related terms, keep following this series and press the subscribe button and the bell icon, and keep following VakilSearch for more. Thank you.